everyone, and thank you so much for joining us today on our webinar, Financial Planning, Be Informed. We have a great panel for you today. We have Jordan Muchnick, Vice President of Lending and Cash Management with FirstService Financial, and Ryan Griffiths, Director of Condominium Finance at CWB Maxium Financial. My name is Avery Cox. I'm the Director of Business Development for FirstService Residential Alberta. For any questions or concerns coming out of this webinar, please feel free to contact me. But for now, I will hand it off to Jordan, and you can take it away.
Thank you, Avery. Good morning, everyone. Welcome to this webinar where we hope to provide information around condominium corporation borrowing within Canada, more specifically Alberta. My name again is Jordan Muchnick, and I oversee the lending group at FirstService Financial. Many of our managed condo corporations at some point in time find themselves in a situation where they're faced with a large capital project without any strategy to pay for those costs. Many associations might be underfunded with their reserves, especially in light of rising labor and material costs today. FirstService Residential has made the corporate decision to align our lending needs with a division of Canadian Western Bank named CWB Maxium Financial. With me today is Ryan Griffiths from CWB. Good morning, Ryan. Can you introduce yourself for our audience and provide some background on your expertise within the industry?
I sure can. Thanks, Jordan, and thank you for having me today. So, as you mentioned, I work for a division of Canadian Western Bank called CWB Maxium Financial. Most Albertans are familiar with CWB, but they may not be familiar with CWB Maxium. So we're a division of the bank focused specifically on providing specialized types of lending. I lead the group at CWB Maxium that provides customized financing solutions for condominium and strata corporations across Canada. On a personal level, I've been in this business approaching 10 years. I'm a board member of the Canadian Condominium Institute. I spend a lot of my time contributing to presentations, webinars, and writing on finance-related topics for the condominium industry. Most of my clients are condominium corporations in Ontario and Alberta, and I primarily help them evaluate funding solutions and options for major repair and replacement projects.
Very impressive. Many of our condominium corporations might not even be aware that they're able to borrow money today. Where have you seen the industry come over the last 10 years?
Well, the industry has come a long way in the last 10 years. So board members and property managers are becoming increasingly aware of the ability for a corporation to access outside funding for major projects, and it's becoming a lot more common for a condominium corporation to borrow. So I would say 10 years ago, there seemed to be a stigma around condos borrowing money, and property managers may have been reluctant to suggest this alternative to their boards. Today, more managers and boards are familiar with financing, and those that have been through the process realize that it's not as difficult as they may have perceived, and that financing can be part of a successful outcome for a community in a very challenging situation. Also, as you mentioned, the need for additional funding is becoming more common. So our condo buildings are getting older. Many are now within this critical window of time where the most major and the most expensive components of their property need major repair or need replacement, right? A condominium corporation has major assets with lifespans that span from 10 to 40 years. And once they get in, but the most major components, once they get within sort of that 25 and 40-year window, that's when all the big stuff starts to fail. And that's where the big things need major repair and remediation. And we've got an increasing sort of number of buildings within that window. The other factor you mentioned in your introduction is the increased cost of major construction. So the cost of major construction projects has increased significantly, particularly over the last 2 years, or even 3 years. Pre-pandemic, it was going up quite a bit, but well beyond what a typical reserve fund study would have budgeted for annual cost increases. So if you look at a typical reserve fund study, it takes the cost for major work and it increases that cost sort of 2 or 3% a year, an inflationary type of increase every year going forward. But the reality is those costs increase much more rapidly. So each project is different, but the best benchmark that I've found is the StatsCan Residential Building Construction Price Index. So this is a summary of construction price data collected by Statistics Canada. So based on this index, if we look at Q1 2020 to Q4 2021, So that's prior to COVID and sort of the most recent data when I last looked. Those statistics and that index says the cost of major construction in the Edmonton market has increased an average of 34% over that 2-year period. In the Calgary market, it's 42% over just that 2-year period. So the difference in the actual increase in construction costs versus what was planned creates a shortfall or a funding need for even the most conservative or studiously planned condominium corporations. By the time you get around to doing the work, it's just the cost is much greater than you had planned. In Alberta in particular, we're also seeing major building envelope projects in particular. So most reserve fund plans never plan for the anticipated scope of work, right? The reserve fund study may have planned to say recoat the exterior of the building or do some siding repairs, but it never planned for the full exterior siding replacement or the full replacement of an EIFS system, and then combining that with things like window replacements or balcony repairs to sort of get the economies of scale associated with that work.
Right. So if an association is considering financing today, what does that look like?
So most financing we provide, is geared towards major project financing. These loans typically work in 2 parts. So you have a construction line of credit that you use to fund the work as the work progresses. Money's drawn down to pay construction invoices. And then at some point, that loan is converted to a fixed rate term loan. So most condominium corporations borrow on a fixed rate term over a period of 5 years, but the amortization period for those loans can be anywhere between 5 years and 25 years. Other reasons a condominium corporation might borrow, we have an operating line of credit product. So this is something designed to help condominium corporations with a short-term need. So this is something that's usually repaid within a year. Some corporations have used this to help with things like a large upfront insurance premium or a large insurance deductible now that these deductibles are getting bigger and bigger. Some are also using this to say, give them time to collect a special assessment, something that's short-term and kind of operating in nature. Other borrowings, particularly in Canada, things like acquiring a guest suite or multiple guest suites or a superintendent suite that a corporation may have to purchase from a declarant. Other items are things like buying out a geothermal system. Some condominium corporations at the outset have a requirement to basically lease a geothermal system or acquire the energy that's produced. We've worked with lots of condominium corporations to buy that system if it's more cost effective for them.
Yeah, a lot of reasons why we should borrow. Condominium should consider borrowing today. And out of curiosity, in your opinion, why would a condominium corporation even want to borrow money? What are the advantages?
Yeah, so I think first and foremost, each situation is unique. The situation for one community is always different for another community. It also sometimes depends on the amount that they're looking at borrowing. Looking at their existing condominium fees, how competitive are they? What under a financing solution, what are our prospective condominium fees going to look like? So each one's different. But sometimes a condominium corporation borrows strategically to spread out the cost of this major project and pay for it through the condo fees. So in these instances, it can be cost effective for the current owners. So if they pay a portion of the cost of this work through their condo fees, and if or when they sell, the purchaser or future owner pays for a portion of these costs through their condominium fees, it can be very cost effective for the current owner, right? In a traditional scenario where a condominium corporation does a special assessment, the current owner bears a large burden of the share of the cost for this major project, sort of a game of musical chairs, right? They get stuck with the cost because they're the owner today. In many situations, a condominium corporation can put that cost back into their condominium fees, and it can pay for that cost over time through multiple owners. And there's some argument that it's more fair to the current owners, and it aligns with the way that condominium corporations are supposed to pay for major work. It's supposed to be paid by owners over time through their condominium fees. So in many cases, it's strategic. In other cases, it's about affordability and making sure that all owners have access to the necessary financing. So, we deal with some projects that are significant, and you could be, $20,000 to $50,000 a unit. So implementing a financing solution through the condominium corporation provides financing for all the unit owners. All the unit owners automatically qualify because it's a loan between the bank and the condominium corporation. People's personal credit, their personal financial situation doesn't come into play whatsoever. In Alberta in particular, it's quite common for a condominium corporation to structure financing on an opt-in, opt-out basis. So this is the type of loan that allows some unit owners to opt out and pay a special assessment for their share of the cost of a major project, and some unit owners to opt in and make an additional monthly loan payment to the condominium corporation in addition to their regular condo fees to satisfy their share of the cost of a project.
Very interesting. I've also heard that there are not many banks in this space that can finance to a condominium corporation in Canada, and there's been consolidation in the industry. What are your thoughts on that?
You know, condominium corporation lending is not a huge market in Canada. It's not a mature market. So there have been some lenders come into this market, not get enough traction and retract. Big banks here have difficulty with the security for these types of loans. So a condominium corporation doesn't have property or assets that can be pledged as collateral. So it doesn't fit the typical sort of asset-based lending model for most big banks. It also doesn't fit the cash flow lending model for most big banks because it's a not-for-profit organization. They don't make profit and have excess cash flow in the typical lending model. So, you know, I have also seen some of the big banks try to make lending available. You know, they'll maybe send out a program letter to their commercial bankers, but they, without understanding the space intimately, they can include overly restrictive covenants that don't work for a condominium corporation. They can be very restrictive in terms of the amortization period. And sometimes it's so restrictive that the solution doesn't really make any sense. So in order to really, I think, do a service to these clients, you need someone who knows the condominium industry, they know how these solutions operate, and they can sort of think about the long-term financial health of the corporation. A commercial banker that hasn't had any experience in this type of lending and has a program flyer, may not be your best partner for something like this that involves people's homes. It's intimate with their finances. It's a unique type of lending, and a lot of banks don't have the experience in it.
Perfect segue. What sets CWB Maximum Financial apart, and why do you think First Service has chosen to partner with us for lending throughout our Canadian provinces?
Good question. It's a hot seat. So look, we've worked with First Service now for many years, and honestly, I think we've earned their trust and respect. So we've helped many First Service clients. We've always delivered on our promises, and we've always come through. So, our interest rates are competitive, and that's important. But I think if I think about it, there's four things that set CWB apart. One is our ability to help boards and owners evaluate their options. So we have tools and processes that other lenders don't have. We spend a lot of time helping boards and owners evaluate their options. And we like to go through the pros and cons of each available option. I'm not here to profess that lending is the best solution in every case, but I am here to help a board evaluate the pros and cons of the various options that are available. Two is we do a lot of work to help our boards and managers through each step of the borrowing process. So in order for a condominium corporation in Alberta to borrow, it requires either an ordinary resolution or a special resolution of the owners. So this means that the board needs consent ranging from, so an ordinary resolution could be 50% of the owners at a meeting, right up to a special resolution that could be 75% of all of the owners in writing. So, this is a process that enforces the community to be educated and allows and empowers the owners to make a decision. So we have proven processes we've learned along the way. We have materials to help the board explain these options to their owners. And we make sure that the owners get answers to all of their questions so they can make an informed decision. So for me personally, it's not uncommon for me to spend 3 or 4 nights a week in owners meetings, helping communities walking through financial solutions and funding options. So we spend a lot of time doing that. And I think our goal is to have the community be as informed as possible and make sure that they make an informed decision so that they get the best outcome for their community. We put a lot of work into those processes. So that's number two. Number three, I think, ties into the first two, and it's our experience, right? This is all I do for a living. I've helped hundreds of condominium corporations through similar situations. We provide guidance and support based on our experience that other lenders may not have. So we can often craft a better solution, and we can foresee potential issues before they arise. You know, at most meetings that I do with a group of owners, you know, I can foresee some of these questions. There's not generally a question that's new. It's not something that hasn't come up before. So we've done a lot of the legwork to kind of think through this and try to answer those questions for owners up front. The last one I would say is flexibility, right? Because we've been doing this a long time, our lending guidelines are flexible. We can provide loans with longer amortization periods. So for a major project with a long lifespan, sometimes that's necessary to keep the payments down as much as possible and provide the best solution for the owners. We also don't have those sort of overly restrictive financial covenants or requirements that can create issues later on down the road for a condominium corporation. You know, a board may not be aware of the implications of, you know, signing a loan agreement with some type of financial covenant and what happens, or the likelihood that they may breach that covenant. So, you know, there's a lot of stuff to think through, but I think our product is more flexible, and it can really be a good solution for a lot of condominium corporations.
Absolutely. Really insightful and invaluable information I think you presented here. You know, we truly appreciate your involvement with this webinar, and I hope the audience has found value with the information Ryan's been able to present and inform everyone on. This now concludes our webinar. We appreciate everyone's attendance. Thank you.
Thank you so much, Jordan, Ryan. You were great. Really informative information that I know a lot of our current clients and prospective clients will be really interested in hearing. For those that have attended, please, if you have any questions, feedback, suggestions, you can reach me at the email on the screen, avery.cox@fsresidential.com. If you have questions for Ryan or Jordan, please let me know and I can put you in touch or get the correct information for you. If you found this valuable, we would appreciate you leaving us a review. Let us know how we did and what you think. Thank you so much, everyone. Have a great day.